They're not hiding the money in some secret vault. They're hiding it in plain sight. And the biggest shift is already underway. The richest investors are quietly rotating out of headline stocks and into the boring, ugly plumbing that keeps the next economy alive. Here's what actually happened. In 2025, the global game changed. Supply chains got weaponized. AI exploded like a power-hungry monster. Governments started treating minerals, data, and electricity like national security. And when the rules change, the people with real money don't argue in comment sections. They move. You felt it, even if you couldn't name it. Prices didn't just move, they snapped. Narratives didn't just evolve, they flipped overnight. And the average investor got whiplash because the old map stopped matching the territory. So for 2026, we don't need a hotter opinion. We need a better compass. Quick note before we sprint. This is educational. We manage risk. No guarantees, no magic ticker. No, this will definitely 10x. Oh, we're not gambling. We're measuring. One more thing before we go deeper. There's a difference between being early and being wrong. Being early feels like being wrong because the price can move against you before the thesis plays out. So we need a risk rule that keeps us alive. We size positions so a bad week doesn't ruin our year. We diversify so a single headline can't wipe the account. We use time as a weapon, not a liability. And we keep liquidity because opportunity shows up when other people are forced to sell. Now here's a contradiction that should make you uncomfortable. The best themes often look obvious in hindsight, but they feel boring in real time. And the market punishes boredom with impatience. So if we're going to follow smart money in 2026, we have to stop asking, what will spike tomorrow? And start asking, what will still matter in 5 years? If we can't hold it through noise, we don't own it. It owns us. And yes, the headlines will try to seduce you. They'll throw a new next big thing at your face every week. Half of it is marketing. The other half is people selling you their bags. We do the opposite. We watch incentives. We watch policy. We watch where capital spending is going. Because CapEx is a confession. If companies are pouring billions into data centers, power, and security, that's not a vibe. That's a vote. Ready? Now we move. Now watch this. Most people will chase returns like they're chasing a bus. They see a stock trending on social media, they sprint, and by the time they grab the door handle, the bus is already leaving. That's why the wealthy don't chase the bus. They buy the road. Because tiny differences compound like crazy. If we invest consistently for decades, the gap between average and slightly above average becomes life-changing. That gap isn't sexy, but it's savage. It turns ordinary discipline into extraordinary outcomes. And the mistake we see every year? People try to get that gap by swinging harder. They crank up risk, they overtrade, they buy whatever is loud. But the quiet way to get that gap is smarter. You don't swing harder, you stand where the next ball is going to be. So today, we're hunting the roads, not the flashy apps, not the celebrity CEOs, the infrastructure, the choke points, the supply lines, the stuff that, if it breaks, the entire economy limps. I'm going to give you 5 big rotations to watch. Not 50, 5. Depth over noise. And each one has a reason, a trigger, and a risk. And while we go, keep this in your head like a heartbeat. If we're right, where will it show first? If we're wrong, where will it show first? Because the market always leaves clues. We just have to stop staring at the confetti. All right, first rotation. The world is waking up to a brutal truth. You can't run a modern economy on vibes. You run it on minerals, not gold chain minerals. I'm talking about the weird, unsexy elements that sit inside your phone, your car, your satellite, your missiles, your grid, your data center. The stuff that makes magnets spin, screens glow, and motors move. For years, the US and a lot of the West treated these materials like cheap groceries. Just import them, swipe the card, no problem. Then 2025 hit, trade policy tightened, exports got restricted, and suddenly the pantry looked empty. This is the moment the rare earth story stopped being a niche nerd topic and became a strategic panic. Because when supply gets cut, it's not just consumers who suffer, it's manufacturers, it's defense, it's the entire production line. And here's the key detail most people miss. The shift isn't we need more minerals. The shift is we need the whole chain. Mining, refining, processing, recycling. That's the difference between owning the ingredients and owning the kitchen. Now pause and think. If you can't refine the material, do you really have it? Or are you just renting it from whoever controls the last step? That's why money follows capacity, permits, processing plants, smelters, midstream facilities, recycling tech that actually works at scale. Because rebuilding a supply chain is like rebuilding a city. It creates contracts, subsidies, permits, equipment orders, and an entire ecosystem of winners. But careful. This is not a buy any miner and pray situation. In fact, commodity businesses can be brutal. Interpretation. The winners tend to be the ones with the best costs, stable jurisdictions, and the ability to actually deliver product, not just promises. And the first crack you watch for? Cash flow, not earnings. Cash. Because miners can look profitable on paper while starving in reality. If costs rise and capex spikes, profit can be a mirage. So if we want exposure here, we think in baskets. Because single company risk is real. Bad management can destroy a good theme. A good theme doesn't save a bad balance sheet. Baskets can mean diversified funds or a small group of quality names we research deeply. The point isn't the label. The point is risk control. Here's your first retention trap question. If this mineral rebuild is so important, why are most people still obsessed with meme stocks? Because memes feel like a lottery ticket. Supply chains feel like homework. But homework is where the money hides. Second rotation. Security moved. It used to be a lock on a cabinet. Now it's a war on a network. Businesses don't store secrets in filing drawers anymore. They store them in clouds. And the cloud is just warehouses full of servers holding everything you love. Customer data, payments, designs, payroll, intellectual property. Now add gasoline to the fire. AI. In 2025, millions of people started dumping sensitive information into AI tools like it's a confession booth, draft contracts, medical notes, private company strategy, internal emails. And the scary part? People do it without thinking. That means two things at once. One, cyber risk isn't slowing down, it's accelerating. Two, cybersecurity stops being a tech budget line. It becomes a survival budget line. And governments are treating it the same way. Because if a country can disrupt your banks, your grid, your hospitals, your ports, your elections, they don't need tanks. They just need access. So money is shifting towards cybersecurity not because it's trendy, but because it's inevitable. This is like installing seatbelts. Nobody loves buying seatbelts, but everybody buys them after the first crash. And here's the mistake most people make. They look for the coolest cyber company, the flashiest dashboard, the loudest marketing, but security isn't fashion. Security is plumbing. The best systems are the ones you don't notice until they're gone. Fact. Cyber spending rises when threats rise. Interpretation. The best positioned companies are the ones embedded in enterprise systems, sticky, subscription heavy, hard to rip out. Risk, budgets can tighten. A recession can delay upgrades. So we watch renewal rates and customer retention like a hawk. Because if customers stop renewing, that's the first leak in the hull. Now watch the open loop. If AI is multiplying attack surfaces, what happens when one major breach hits a company that trained models on private data? Do regulators step in? Do insurers raise prices? Do businesses panic and overspend? That reaction function matters more than the breach itself. We don't need to predict the next hack. We just need to accept the direction. More AI usage, more cloud reliance, more digital warfare, more defense spending through software. And here's your engagement question. If a company's revenue is up, but its security spend is flat, what does that tell you about management, confidence, or denial? Drop your take in the comments because this is where we separate disciplined operators from the ones playing pretend. Third rotation. Energy. This one is the quiet monster under the bed. It doesn't trend on social media, but it decides who wins the AI era. AI is not just software. AI is a factory. And every time we ask a model to answer a question, we're firing up chips, storage, networking, cooling, and power, like turning on a stadium for a single conversation. Multiply that by millions of users, then businesses, then governments, then autonomous systems, then robotics, then defense. This is why the next economy is, at its core, an energy story. And energy is a cruel business, because demand can surge fast, but supply cannot. You can't download a power plant. You can't ship a transmission line overnight. You can't pivot to more transformers in a week. So money is flowing into anything that reliably produces power, moves power, stores power, and stabilizes power. Because if electricity is the bloodstream, AI is the new organ demanding more oxygen. Now, policy started shifting the energy conversation. Traditional energy regained political support. At the same time, the demand curve didn't care about politics. It just kept climbing. And here's the twist. Oil and gas can help. But they don't solve everything. Not fast enough. Not clean enough for every use case. Not stable enough for the grid stress that AI creates. So we're seeing renewed interest in nuclear. Not as a sci-fi dream, as a practical baseload solution, something that can run 24/7, rain or shine, without praying for wind. Fact, data centers want consistent power. Interpretation, the power providers that can guarantee uptime gain leverage. But again, risk. Nuclear projects can be slow, they can face regulation, they can face politics, and markets can overhype themes before reality catches up. So our job is not to fall in love. Our job is to map the bottlenecks. What's the bottleneck in energy? Permits, transmission, fuel supply, skilled labor, and time. And the sneaky bottleneck nobody talks about? The grid. Because even if you generate power, you still have to deliver it. If the grid is congested, your cheap electricity is like water behind a dam with no pipe. So the winners are often not the loudest energy brands. They're the ones selling the picks and shovels, grid equipment, transformers, switchgear, cooling, engineering, maintenance. Now watch the psychological trick. When energy prices fall, people think the story's over. But energy demand in the AI era is not a seasonal fashion trend. It's structural. It's a rising tide that keeps pushing against the same shoreline. Fourth rotation, biotech supply. This one gets ignored because it's not glamorous. People want the miracle drug. They want the headline. They want the single company that cures everything. But smart money often prefers the toll booth. Here's what happened. After the pandemic era surge, a lot of biotech and pharma supply chains overordered. They stocked up on everything. Then demand normalized, and they went into destocking. They stopped ordering. They burned through inventory. That creates a weird quiet period where suppliers look weak even though the long-term need never disappeared. And when destocking ends, orders snap back. Not because the world suddenly loves syringes, but because the shelves have to be refilled. Now, layer in a second force. More drugs are delivered through injections, weight loss treatments, chronic therapies, at-home administration. The more injections happen, the more tools get consumed. Syringes, vials, stoppers, cartridges, delivery devices. This is why the picks and shovels approach matters. If the drug race shifts, the tools still sell. Different drug, same needle. Fact, tools get consumed regardless of which brand wins. Interpretation. Durable suppliers can behave like infrastructure businesses inside healthcare. But risks exist. Pricing pressure, regulatory shifts, and the reality that healthcare markets can be messy. So we look for signals. Backlog improving. Volumes stabilizing, margins holding. Because if demand is real, it should show up in orders and cash. Here's your next open loop. If the flashy biotech names are the lottery tickets, who quietly owns the printing press that sells tickets to everybody? Hold that thought because it connects to the fifth rotation. Fifth rotation, AI infrastructure. This is the backbone, the pipes, the steel beams, the real estate under the skyscraper. Most people argue about which AI model is best. That's entertainment. The wealth is often built one layer below, because regardless of which model wins, the infrastructure has to expand. Data centers, semiconductors, networking, storage, cooling, power agreements, specialized real estate, construction. Think back to the internet. Plenty of .coms went to zero, but the infrastructure, the cables, the routers, the server farms kept expanding. The shovel sellers won even when some miners went broke. That's the same pattern here. And here's where 2026 gets dangerous for casual investors. Infrastructure stories can look safe because they're real. But real doesn't mean cheap. If everyone crowds into the same obvious trade, returns get squeezed. So we focus on the middle layer, the companies signing multi-year contracts, the landlords renting space, the suppliers shipping cooling systems, the chip makers and networking providers that sell the tools, not the dreams. Fact, infrastructure build-outs take time. Interpretation, the best opportunities are often where timing and capacity meet, and we need to ask a sharp question. What's the market paying for? Growth or safety? If everyone piles into the same story, returns compress. If everyone ignores the boring middle, opportunity lives there. Now, the shadow theme that hangs over this entire section. Real-world constraints, land, water, permits, local politics, construction crews, and again, transformers. Transformers are like the lungs of the grid. Without them, nothing breathes. So if we want to be early, we watch what's scarce, not what's popular. Now, one more layer, because I promised retention, not fluff. Robotics. I'm not counting this as a sixth main rotation, because we said 5. But robotics is the physical extension of AI infrastructure. It's what happens when software stops talking and starts doing. Factories that run with fewer humans, warehouses that move like ant colonies, hospitals with precision machines, restaurants with automated assembly lines. Robotics has been almost there for years. The shift recently is that the economics started improving. Sensors got cheaper, models got smarter, integration got easier, and labor shortages made automation more attractive. Possible. Profitability scales faster than expected. Risk, early hype outruns margins. So we treat robotics like a longer-dated option on productivity, not a guaranteed winner. A trend with uneven adoption that can still reward patient positioning. And if you're thinking, this sounds too slow, good. That's the point. Fast money hunts excitement. Smart money hunts inevitability. Excitement fades. Necessity compounds. The only question is whether we position before the crowd or after it. That choice decides who gets paid first. Now, let's stitch the picture together without wasting time. In 2026, the wealthy are not just buying stocks. They're buying leverage on necessity. Minerals, because supply chains are strategic now. Cyber, because data is the new target. Energy, because AI eats electricity. Biotech tools, because healthcare keeps consuming the basics. AI infrastructure, because the backbone expands no matter who wins. Do you see the common thread? These are not fads. These are foundations. And foundations are where we can compound without constantly guessing the next shiny thing. But we also don't get lazy, because the market is a casino designed to punish certainty. We use a certainty ladder. This is clear. This suggests. This is possible. And we keep updating as facts change. Now, quick and simple CTA, because we build this community together. If you want more of these, follow the flow breakdowns, hit subscribe. We're tracking the money, so it doesn't blindside us later. And I want one more comment from you. Which of these 5 shifts feels the most underpriced in your mind? And which one feels overcrowded already? Minerals, cyber, energy, biotech tools, or AI infrastructure? Pick 2. One underrated, one overhyped. I'll read the replies, because our edge is thinking together. Here's the cliffhanger I promised. The real fight in 2026 isn't about which stock spikes next week. It's about which bottleneck breaks first. Is it a mineral export restriction that freezes manufacturing? Is it a cyber attack that forces new spending overnight? Is it a power shortage that stalls data centers? Is it a supply crunch in healthcare tools that delays treatments? Or is it the construction bottleneck, permits, transformers, land, that slows the AI build-out? Because whichever one snaps first, that's where the next wave of capital will flood. And when that flood starts, you don't want to be the person sprinting after the bus. You want to already own the road.